Hello, everyone. We would like to thank you for joining us on a lovely Saturday morning. Today, we welcome you all to our webinars, our corporate webinar series, India's Silent Bull Run, Decoding the Q2 FY26 Earnings, Market Psychology, and the next big theme for investors. And today, we have with us GR Balaji Sir, co founder and CIO of FPS Assets. GR Sir always says this one saying that there is always a bull run somewhere. And today we are here to decode the India silent bull run. So before we start, I would like to give a disclaimer to all our participants that this webinar is only for educational purposes and does not constitute an investment advice. We request all the participants to invest at their own discretion. With this, I would like to hand over the webinar to GR Sir. Thank you
Hey,
everyone for joining.
thanks, Komal. I'm audible, right? And screen is visible, correct?
Yes, sir. Yes, sir.
Okay. Thanks all for joining for a wonderful Saturday. As alluded, right? We've been doing on corporate India webinar for quite some time, and I thought, why don't we do with slightly modified version of silent bull run, which is happening? But obviously, right, this bull run is not felt deeply by a lot of investors. So we thought we'll decode a bit of it and then obviously share our perspective, how we see the world in 2026. And then obviously, right, we'll do a Q&A. So maybe quickly next 30 minutes, I'll run through how are we seeing the data. And then obviously, right, we will take the Q&A in the end. Just a second. Um, Komal, the slide is changed.
Yes, sir.
Okay, so the major topic we're going to speak is the silent bull run, which we want to speak about. The second one, why I am not feeling this bull market, right? A lot of participants in the market is not feeling today there is a bull market, obviously for a variety of reason, and we'll try to see how best we can address this problem. Third, how are the corporate India is delivering, and the fourth, finally, is the conclusion and the outlook. So the mega thing which we consistently track, and I'm sure if you would have attended our previous webinar also, is the mega bull market happening in India's GDP. To put in context, our GDP has significantly risen in the last 20 years from a 38 lakh crore economy. We moved to 87 lakh crore economy in 2011-12. And by end of this year, we should be close to 350 to 360 lakh crore economy. This is a nominal GDP. And obviously, right, so consistently India's GDP has grown 10%. I think this is the one number which every market participant should be aware. And the whole idea about when this 357 will become, let's say, 1,000 lakh crore economy, right, in the medium term of a 10-year period, how well we can capture is the very important question which we need to always ask and then see how can we position ourselves to capture the rise between this 350 lakh crore economy to a 1,000 lakh crore economy, right? Because when India moves from a 38 to 87, it needs a very different requirement. 87 to 357 had a very different requirement. So from 357 to 1,000 or plus 1,000, right, needs a very different infrastructure, a very different services will get enabled, and that will be the opportunity for all the equity investor and fixed income investor as well. Coming to our belief system, we consistently keep telling there is always a bull market somewhere. So, as an allocator of a capital, our job is to see where the bull market is happening or expected to happen and position our portfolio accordingly, right? Instead of we saying, I invest in X place and the bull market has to happen, I think the better way to allocate capital is where the bull market is about to happen, you allocate capital, wait for the period and enjoy the bull market. So we see bull market happening in multiple places. The first thing is, before getting into the data, I want to bring the context in which we are going to speak on this bull market and the address on the results, right? So BSE 500 is a typical universe which as a house we track. And if you look at the total market cap of BSE stocks, all 5,000 odd companies got listed in India is 471 lakh crores as of yesterday. And if you look at BSE 500, it's 408 lakh crores. So basically, 88 to 90% of India market cap is captured by this 500 company. So as an investor, I think if you have to start somewhere, a BSE 500 is a phenomenally a good universe to start because it captures almost like a 90% of your market or our market, right? So if you see BSE 500, right, phenomenal profit growth then. So basically what we have done in this data is We have taken trailing 12-month period profit of BSE 500 for last 6 years, every quarter, every 90 days, and plotted it. So September 2019, the TTM, which is last 12 month, between September 2018 to September 2019, 12-month period, BSE 500 corporate profit aggregate was 4.5 lakh crores. Due to COVID, it fell to 2.65 lakh crores, right? So market anticipated the fall of profit, market fell. But market had a very precision judgment about the recovery of profit. So if you see, market started recovering sometime here, profit bottomed out, and actually had a very quick turn in 4 quarters. The profit moved from 2.65 lakh crores to 7.76 lakh crores. Then a moderate growth. So we had a V-shaped recovery in the market, which is what led the market profit pool also recovered. Then there was a moderate growth between 776 to 1028, right? 10.28 lakh crores. Then now, if you see, it is close to 17.10 lakh crores, right? So clearly, we are seeing a significant, consistent profit growth happening across time period, and currently at this point in time, it's all-time high. So if you look at where the bull market, right? So first bull market is happening in Nifty. So this is a yearly chart of a Nifty. And if you look at consistently in the last 10 years, every single year the Nifty has given a positive return. So this is a very rare period where index consistently delivering a positive outcome. Obviously, it's not a very fat return, but very consistent upward curve reflecting how well the economy is behaving and how well the bigger companies are capturing it, right? So definitely, this is something which we need to keep an attention. And if you look at another index, which is banking index, after lull period, it's also hitting close to all-time high. In out of last 10 years, you have seen 9 odd years, you have seen a positive return. So I think the bull market is happening today now in large caps, particular segments like banking. And actually, the most, what to say, spoken about topic is gold. And the biggest bull market in the last 1 year has happened in gold, silver, or a lot of metals, right, globally, reflecting again our house philosophy. The bull market happens somewhere, and we need to position ourselves well. So the big picture is for every investor. I think this is the only metric I keep consistently wants to follow for ourselves and for investor is how much earnings is growing, how much markets are growing. And I think the beauty is for the last 20 years, we have seen GDP growth of close to 10%. 10% growth of GDP led to 12% Nifty earnings growth, which is top 50 Indian companies. And the market growth, which is broadly reflected by Nifty 50, at least from a broad perspective, has grown at 13%, right? So actually, our market growth is a function of domestic GDP growth, leading the corporate delivering 12% growth to the market, right? So it's a very fundamental driven growth, what we have experienced in last 20 years. So the $1 million question to all of us is, so much good things have happened, but why I am not feeling this bull market? So definitely pockets of market is feeling the heat. So that's why we labeled this entire title into silent bull market rather than a roaring bull market. So let us see some data point why a lot of us are not feeling this bull market and then how we can position ourselves in the 2026 and 2027. The first thing is when we looked at data very interestingly, even though index is close to all-time high, which is Nifty or a couple of index, the beneath the market has actually fallen a lot. So what I've done is this is as of last week data. Top 50 stocks average fall from the 52-week high is 9%. So that's where if you see index is close to -3, -4 from all-time high because banks are close to very much high. And if you look at BSE 500 aggregately is actually -20 average stocks reflecting the 20% is definitely considered to be entry of a bear market, right? So definitely BSE 500 average stocks have entered into bear market. And if you look at bottom 50, so the top 50 aggregate and the bottom 50 out of BSE 500 has fallen roughly 35%, right? So the 50 stocks average is -35. I'm sure when you again double click this data and see there are few stocks have fallen more than 50-60%, reflecting, I think at the underlying level, the smaller stocks have fallen a lot more. And this is only BSE 500. I have not even gone to microcap index, which is 501 stock to 750 or beyond microcap, where a lot of exposure is being taken in the last few years, right? So I think this is where the current Nifty led bull market is not experienced because maybe few of us are positioned little more than what it is needed at this point in time, given the macro construct, which I'll speak in next couple of slides. So the chart, what it's showing, right? We saw Nifty chart, banking and gold. But if you look at Nifty micro cap or Nifty small cap charts are showing slightly a very different picture, right? They peaked early, later part of 2024. We fell, we bounced like a cat bounce. Again, actually, we are drifting low. A very similar structure is seen both in small cap and micro cap, reflecting at least here the investors are getting tired, they are getting overexposed, and now you're seeing a very consistent trend about every day slowly the selling is happening, and obviously in few counters the selling is happening extremely brutal. So I would consider this is like a boiling frog syndrome type of a scenario where people are not able to see the bruises, but slowly we are getting impacted by this cut every single week. So why the small and mid cap has been falling, and right, and what are the fundamental reasons? So I thought we'll share few reasons, which is what hitting us in our mind. The first thing which I've been consistently telling our investor is not every small cap is a high growth, right? So there is a general narration: smaller the company, the growth is better. But when you look at the data doesn't support, and I'll share how to look at this data. This is basically BSE 1000 companies we have taken. What I've done, I've taken a sales growth for last 6 years individually, 2019, 20, 2021, like 6 years, and plotted number of companies which has grown 6 out of 6 years, 10% growth rate, very bare minimum nominal GDP growth. Within large cap, only 2% of the universe is growing consistently 10% and above every single year for last 6 years. Just 2%. Vis-a-vis, if you look at 6% of the large cap universe is not growing even not growing at not even more than one time out of 6 years, more than 10%, reflecting growth at 10% is a very difficult yardstick, first of all. And when you look at small cap, this is where the data gets interesting. 4% of the small cap is consistently growing more than 10. Yes, it means some small cap consistently grows more than 10. That is the right answer. But at the same time, if you look at 11% of the small caps have not even grown more than 10% last 6 years, only one time, right? It clearly reflects in small cap, the divergence are varied. So there are small cap which grows better, consistent, and there are also small cap which doesn't grow consistently, right? So instead of we saying every small cap consistently grows because of their small, the data is clearly supporting in small cap, the variance is large. Certain small cap tend to grow better, and every single year it grows. It gives you a lot of stability. But certain small cap doesn't even grow, and for a very long period, right? So I think this is where when the macro gets tougher, people start questioning the growth and valuation, and then the sell-off is coming in, right? In a lot of counters. Surprisingly, mid cap has a lot more resilience. I think maybe probably they have the maturity of a large cap, but the size of a small cap less. That gives you a lot more maturity from a growth point. But obviously, from a valuation point, today's mid cap scenario is far more expensive. So, second challenge, right? Apart from this narration of small cap is only a growth, we have seen the data very clearly. The second challenge is the macro. As an investor, right, I consistently see among a lot of large investors also, we are very micro driven. We really read about the balance sheet, cash flow, business model. I completely appreciate the most nuanced part of that. But I think primarily, if a company has to success, the wind has to blow. And I think one of the major wind for every corporate is the government led push towards the growth. And if you look at now, right, the last 4 years, India has been fiscally consolidating. And during this year also, right, the most probable expectation was we were thinking about revenue growth. Revenue receipts of the government is 13%, but looks like we will end between 9 to 10%. And if you look at income tax growth is also lagging. GST growth obviously lagging because of we have given the rate cut. So one of the things we have seen is a lot of companies which are government focused cash flow driven businesses like Jal Jeevan beneficiaries or road construction companies, right? We have seen a brutal fall of 50, 60, 70%. And one of the questions keep coming back as allocator of capital, why the business has slowed down? I think when the government revenues comes down, right, they are constrained. They have to do a fiscal consolidation. At the same time, now they are focusing on consumption. So if I have an X revenue and I have to redirect the money to consumption, I have to pull back the money from an investment, right? And that is what classically playing out. And you see a lot of government-led businesses have actually corrected between 50, 60, and 70%, right? So this is the second data point why currently we're feeling the challenge. And the third data point, I think the mute topic for everyone is the rupee. A rupee been a pretty stable currency for a period of 23 or I mean 22, 23 period, right? They're a very stable currency. But this 25 year turned out to be a very, very, what to say, very volatile year. We have actually depreciated close to 8%, quickly moved from 85 to 91. And I think primarily we have a reasonable current account deficit, but we have a balance of payment issue, right? Because of we have a very poor FPI flow, poor FDI flow. That is what putting pressure and the risk of trade off, right? Primarily due to the trade barriers currently we have for our sectors, creating a lot more pressure. So I think these three challenges of one, the narration is changing. Every small cap is a growth company. Second, government revenues are under pressure. And the third, little bit of a macro concern on rupee. And then these three has unfolded little more stress into the small and micro cap. So having seen this, what happened to the Mr. Market, right, which is the broader market? I think if you look at market have delivered close to 8 to 9% and the Nifty, this is YTD 1 year return, and the small caps have delivered -4 to -5. This is basically index. So there is a definitely a variance of 13-14% outcome performance. This has happened irrespective of the flow which domestic was flowing in, right? Close to 30,000 crores of our money is consistently moving into the markets. So one of the question which everybody said is when the SIP flow is very good, how can the stocks can correct? I'll reiterate, flow is a temporary. It means when flow comes, it supports the price. But when the fundamentals doesn't support, the moment the buying stops, the price corrects, right? So instead of we allocating capital only based on the flow, the first primary driver should be the valuation. Definitely flow could be a supporting factor and but not the only factor. And I think last 12 months, having we invested few lakh crores into small and mid cap and micro cap, still markets are down reflecting flow alone will not take care of the market, right? We need fundamentals, we need right valuation, we need growth. With that, flow could be a far more supportive factor. So what has happened is with this underperformance, I think Indian market has really, really underperformed across the world, right? So if you look at there is a bull market big time happening outside India from Korea, Taiwan, in US particularly AI trade, China also AI trade, right? So it is either AI trade or it is gold and metals or some pockets of emerging nation. So these are the three big winners of 2025. And if you look at India, right, we have performed close to zero and clearly reflecting this is where the next big opportunity will open up and which I will share at the subsequent slides. So what has changed, right? So having spoken about structural bull market happening in the profit pool in BSE 500, how the challenges have come in, how small caps have performed, we have seen. Now, what has changed now, right, in the last 15 months with this consolidation? The first thing is growth was the concern. Now, policymakers, both by the government and the Reserve Bank, have clearly monetary policies been consistently want to support growth. So we have seen monetary easing consistently. We have seen the budget tax cuts. We have seen the consumption boost happening via GST, and looks like a lot more expected in 2026, 2027. Somewhat of relaxation happened in NBFC credit, which should happen to grow. And finally, government is also trying to see the ways and means in which the government capex can improve. Obviously, it's sporadic. H1 significant growth has happened, but we need to see how H2 will play out. The operating numbers, which is actually September quarter, I would say slightly a breakout quarter. Obviously, the narration is the growth is slow. So sales growth of the entire BSE 500 is 8%. Large caps have grown 7, mid caps have grown at 11, small cap have grown 9. So the aggregate sales of the BSE 500 for the period September, right, quarter is 40 lakh crores, grown at 8%. But interestingly, if you look at PAT growth, right, we have grown at 16% with large cap 13, mid cap 21, small cap 34. This 34 we need to see in the construct of the base of the small cap in September quarter. But if you adjust this, that also, right, there is a decent growth reflecting definitely growth is getting slightly better, if not extremely good. We need to see how Q3, Q4. I think the market is waiting for this Q3 numbers, which we are maybe at 20 days out. But I think if Q3 can substantiate some improvement and the commentary getting better, right? I think it could be a very good window to allocate capital across the market caps. The second thing, which is our favorite slide, is the sales path matrix, where we divide the entire BSE 500 into the four buckets: less than zero sales growth, 0 to 10, 10 to 20, greater than 20. So if you look at green, right? So there are a lot of companies still delivering operating profit growth more than 10%. But at the same time, this orange or yellow bar, where a lot of companies still not actually producing any amount of growth. So reflecting, so there are places where the growth is happening and there are places where the growth is not happening. So where are we in the earnings cycle? So we clearly saw earnings momentum went down sharply in 24, 25, 25, 26. So I think this last 2 years been a very low earnings momentum. So the way to look at this metrics is, this is earnings momentum. This is the quality of the corporate balance sheet. Corporate balance sheet continued to be extremely good, which is in terms of the low debt to equity ratio, high profitability, high cash flow, all that, right? But if you look at the earnings momentum, weakened in 24-25, continued in 25-26. But what we clearly see is, in next 2 years, which is 26-27 and 27-28, we are going to move from a low earnings momentum to a medium earnings momentum and not high earnings momentum. So typically from a low single digit earnings momentum, the broad expectation of market is now to deliver 13 to 14% earnings growth for the next 2 year period, primarily led by banking, which is a very large segment of the index, and the auto, then a little bit supported by pharma, a little bit recovery of discretionary consumption, and so on, so forth. So what is this giving is a lot of stability in the earnings cut is coming through. So post September result, what we saw is, this is the earning estimate of 2026, which we started at 1205. We have ended at close to 1079, 1080 or 1100. So 100 rupee decline happened, right? But if you look at off late, the earnings is getting stabilized. It means as a sell side or the analyst, right, they are very confident now. The earnings momentum is stabilizing, and that we are seeing even in 2026 and 2027. I think this should give a lot of confidence to the market participant. I think now the estimates are far more reasonable than what maybe a year back, which is what the market penciled in. So valuations are little reasonable. I don't think we are in a cheap market. So one of the questions keep coming up as an allocator of capital. Since the market has been consolidated, can I expect a very high double-digit return, 15%, 20%, about 20? I don't think we are in that moment at this point in time in the market. We are in a place where the excess got a little bit of corrected. I think anybody looking at a 11 to 13%, or I would say an average 12% type of a return expectation at the portfolio level, I think this market is designed for that. For this 12 also, we need to be a little more prudent the way we allocate capital, reduce the mistakes, and be a little more disciplined to earn this return. And I think 2025 taught us, all of us, that now the easy money, which was between 2021 2024, is done. 2025 turned out to be a very difficult year. From 2026 onwards, I think we will make money, but it should be a reasonable expectation of close to that 11 to 13% types. So the setup of the market 15 months back, balance sheet was good, valuations was stretched bit, growth was getting bad. Now balance sheet is good, growth is getting better, the commentary is better. Hopefully, we will see the growth better. Valuations are little more palatable. I think that is why, as a house, as FPS assets, right, we are slightly more bullish now than what we were 15 months back, and that will be reflected in our broad asset allocation and the thinking point of view. So our positioning in 2025 was very, very clear for all the investors. We predominantly allocated capital to hybrid using balanced advantage funds and the equity savings fund type of a category. We have used well-run, high track record, conservatively driven flexi caps and with a good AUM. So they give a lot of stability. Select thematic funds we have used. We have used a lot of index funds for our investor to allocate capital to capture the beta return and the arbitrage, to see when a market window opens up, how we can use it. We were significantly underweight in mid and small cap, or I would say zero position in the mid and small cap given the valuation risk. But what is changing at this point in time, having seen the correction happen in the last 3 4 months significantly, and we are seeing growth drivers are in place, it's about to happen. The slight change in our thinking now is we are probably heading to a place where we're slightly going to move little more closer to, if you see the small cap, which used to be close to underweight, we will be consistently going to be underweight, but not significantly underweight. So some bit of an exposure will be encouraged given the price correction. So as we say, right, we are slightly turning, I would say, greedy in terms of this segment where the price is corrected. So the valuations in some pockets are getting favorable. As they say, right, when valuations are good, we would like to allocate some bit of a capital, not excessive. So that's a broad thinking. Otherwise, primarily, we look like hybrid flexi is going to give a lot more opportunity. And if the price were to correct significantly, lot more step up can happen in mid and small cap. So to conclude, the way we think about returns, and I've been telling about 11, 12. So this is a very interesting way to think about return. This is called truly objective, where the returns are captured at different point in time. So if you're a 2005 investor, I'll tell you how to think about this chart. It gives you a lot more clarity. If you're a 2005 investor, your first year return was 36, your second year return was 38, right? Third year 43. It means you have compounded your capital at 43%, significant. Then came 2008 crash. And if you look at in the last 20 years, this 2005 investor have compounded his entire capital at the rate of 13%. Vis-a-vis, if you look at maybe a 2013 investor who came at very tough period in the macro, started off very badly, 7%, but gradually improved close to 12% on 13th year. What it truly reflects is, in the short term, market returns are extremely varied. You have seen years where very high return, years of very low return, years of a very moderate return. But over a period of 7 to 10 year and about 10 year, right, the returns are getting very, very clustered around this 10 to 12%. So the green is where the more than 10% we have labeled. And if you look at consistently, it's been green, reflecting there is no negative return. And I think your return expectation about this 12, 13 is fulfilled if you can stay more than a decade, right? So I think any investor who are coming to equity today with a 5 to 10 year outlook, I think this type of anchoring will give you right expectation from the market. And the last but not the least, what are we thinking about at this point in time? Economic cycle is okay, earnings cycle is okay, and will get better in H2 with a lot more push by the government and the monetary policy. But we have to moderate your portfolio risk in terms of concentration. So if you are as an investor are over allocated to small cap, mid cap, and a lot of PMS, right, which in the last 4 years has become big, I think you need to rework on your portfolio structure, take a good second opinion, and then obviously keep your portfolio ready for the future facing. Consolidating market gives you a very good window to make the portfolio future focused. That's what our endeavor to our clients. We clearly see, we have seen enough of margin driver happen in the last 4 years. I think from here, the biggest driver of value from corporate will be sales. So this is the only metric. If someone wants to track out of corporate India as a sales metric, the sales number has to grow. For the sales number to grow, one of the metric we need to again have to see is the nominal GDP growth. Currently is sub 10. I think next 2 year period, we should definitely see nominal GDP growing between 10 to 12%. That should reflect in corporate sales growth. Finally, we believe risk to reward is favorable consistently at this point in time in large market capitalization segment, which is what we're capturing using the lot of index funds. There are close to 100 plus index funds. So we're using selective index funds to give a very good exposure to our clients, and very selective, I would say, small cap PMS funds. We are turned positive given the entire sell-off has happened in the last few months, right? So this is what our current belief at this point in time. And thanks for your time, for giving your patient listening, and we'll be very happy to answer. To end, as Komal have told, this entire material is more from an educational point of view. Please consult your MFD or an advisor, however you consider appropriate to take any investment decision. We are an SEBI PMS registered, AMFI registered distributor. We have a PMS distribution license, and so on and so forth. And thank you. This is what the services are. We distribute PMS, mutual fund, AIF, fixed income, and all other regulated assets out of India, right? Thank you. Komal, we can open the floor for questions.
Hello everyone. The floor is open for questions. You can type in your questions in the chat box. The questions will be open for the next 15 minutes, and the next set of questions you can, if you have any further questions, you can email it to us at info@beyondmf.com. So the first question is sir from Vivek Kunshekar. He is asking is how do you expect the growth coming on banking and autos?
1 second. So primarily, it's a good question. I think what has happened is, if you look at nominal GDP growth, right, which has come down dramatically from 12% to today 8 to 9%, and we have seen the inflation at close to 2%, right? So our broad expectation is inflation will pick up, and that's what the RBI estimate, right, from sub 2 to close to 4%, which should support the nominal GDP growth. And the moment the nominal GDP growth were to come in, the credit picks up in the factor of 1.2 to 1.3. So the first thing is the credit growth will come back, and with credit growth, what we are also going to see is the NIMs will stabilize and which should support the net interest income. So you're going to have the top line growth, stable margin, and if there is no credit shock, right, because of a GDP is going to grow, we're not going to see any credit cost. That should be a far more supporting factor in terms of the banking growth. So the broad estimate today, after a very subdued 2 year period, is between 12 to 14% growth expected out of banking, and that's what our broad view in there.
All right, so the next question we have from Mr. Bala Subramanian sir. He's asking your view on large cap mutual funds.
Well, a large cap mutual fund, I think one of the data which I think me and my team, right? So we have a 6 member analyst team doing work on across mutual fund. We interestingly saw only 2%, or I would say two funds out of 40 funds have outperformed benchmark last 1 year, and close to only 40% of the large cap funds also outperforming the benchmark. So the way we are seeing is we're using a lot of index funds as one way to capture the beta return, and selectively one or two large cap is what we're allocating capital to our investor. But I think broadly we see value happening out of the space, but the way to capture could be an index funds, or maybe probably you choose funds with a good exposure in a particular segment where you're bullish at the portfolio level, expense are pretty decent, and obviously, right, that's how you're going to make. Otherwise, the alpha out of a large cap fund over the index could be a little more challenged, and that's what the data has suggested in last 6 years.
So the next question we have from Mr. Yash. He is asking with the new grids and round the clock distribution, how do you see the power sector in the long term?
I think the power sector is a biggest play which has been underestimated, I'm sure. If you look at three mega trends happening globally, one is AI, which I think the talk of the town, because every US conversation should end with an AI, right? Because the Max 7 is fully capturing it. A lot of stocks have hit. Obviously, Oracle hit all-time very significant high and fallen because of the debt requirement of AI. The second was GLP-1. We have seen the weight loss drug is creating a huge wave across the world. I think that's a big trend. The third mega trend is on the power side, because AI is a very power intensive, and I think we need, right? And if you can see, India is just enabling nuclear power, right? So clearly reflecting everybody's understanding with AI, you need to have extremely high power intensive systems to better manage this entire growth. So the next incremental GDP of the world is going to be power intensive, money intensive. So definitely the sector is poised for a very sustainable growth. But again, we are not doing anything particular on stocks, right? So we are distributing using the funds. We are positive on the sector. Obviously, when we allocate money, right, we will look into the portfolio manager who is having a good exposure to this segment, which can capture the growth not for 1 year, 2 year, and for a 5 to 10 year, right? So I think power is going to play a far significant role than what it played maybe in the last 10 years. Hope that
All right.
answers your question, Yash.
Yes, the next question we have from Mr. Raghuraman. He is asking about the international funds for the current market cycle, especially US
Okay.
and China.
Good question, sir. I think at this point in time, we are not strategically allocating to international funds because, as you rightly said, the big rally of AI is, I think it's been happening. People are calling AI bubble. We don't know. But one thing is very, very clear. This business which in US, right, the Max 7, which has tremendously grown for last 10 years with a high free cash flow, that business model is changing. They're significantly investing more than hundreds of billions of dollars into AI, thinking the way they will be able to monetize. So I think these are very early days, but you need to be very selective. So I would say if you're a very long-term investor of a 10-year period, want to capture dollar assets, want to capture the trend which you cannot track of India, I think it makes sense to allocate from a portfolio standpoint of view. Maybe 5 to 10%, I think we should limit, but not a very tactical call with a 2 to 3 year outlook. His assets are cheap. Probably China could be a swing trade. You need to be a little more careful. We are evaluating at this point in time various funds and various ways to capture it. US, those are a very strategic call with a 5 to 10 year, maybe a systematic way of building US portfolio makes sense, not maybe a lump sum at this point in time in US. But you need to appreciate having exposure to US makes a lot of sense in the 5 to 10 year period because even FY26, Indian EPS growth is close to 14% nifty. But if you look at Max 7 earnings estimate is close to 20%, reflecting the Max 7 or the US, the AI trade, companies are growing much, much better. But the question is, how much of this already baked into the valuation? So you need to be a little more slow to accumulate these units. But if you have a 5 to 10 year view, I think taking a small exposure to US makes sense. China should be a lot more tactical at this point in time.
Yes, so next question we have from Mr. Piyush. He's asking your view on underperforming sectors like textile, paper, building materials, and chemical.
I think textile, right? It's a straightforward case. What happened with, I was in Tirupur a couple of months back and we saw very difficult environment for all the textile players because of this entire trade issues. Hopefully, I think 2026 should be a better year. Paper, no particular perspective. This is always a cyclical trade, right? Whenever you see volume growth where to come and the benign environment you can play. We don't take any view. There is no particular fund also to capture a paper segment, right? From a overall at this point in time. Building materials, particularly few building material prices have corrected significantly. But the volume growth at the aggregate level is still happening, right? At least the bigger players like DLF, Prestige, Brigade, everybody is reflecting the volume growth is happening, but at a slower pace. But I think the price correction is very, very steep. And a couple of businesses are fallen deeply, right? So maybe that is one segment which is turning a little more attractive. So one of the PMS where we are very bullish, have a very positive outlook there, and that's how, right? As an allocator of capital, we are using very selective products within our exclusive bucket to give money to our investors to capture this type of a growth. And the chemicals is again, it's a global play. As I see, right, the sector is still bottoming out, has put a lot of capacity. ROEs have hit the low point. So I think instead of saying a bull market is about to happen, I think maybe the bad things have happened to them, right? So they have built the balance sheet, they've expanded the balance sheet, they put the capex. Now they need both volume growth and price stability. And I think any China and evolution of reducing the capacity and helping the players to get a lot more volume, right? It could be an interesting play. And there is one index recently been launched, and one AMC has already launched an chemical index, right? ETF, which we are actively tracking as a team, and hopefully, right, at some point in time, if it makes sense, right, it could be a tactical trade. Hope, right, I've answered some part of your view of Piyush.
So next question we have from Mr. K. Anand. He's asking on IT sector.
IT sector, I think, surprised last few months for all of us, right? The index rallied. So we saw this was coming in 3 months back. So what we did is we invested into an index fund which had 8 to 10% significantly overweight on IT. And then we captured a rally. But I think IT could be a trade, not a structural investment. For a reason is, if you look at a very long period for last 20 years, IT dollar earnings revenue growth is coming down from a high, I'd say teens to low teens to high single digit to now maybe a 4 to 5% dollar earnings. So what IT definitely need is the lot more stability on this earnings growth. So it is a segment where you're going to get 8% to 9% earnings growth for a very long period vis-a-vis a market growth of 12 to 13. So it's going to be sub market led growth. But at some point in time, it could be a tactical trade. These are very good business from a balance sheet, cash flow, dividend yield. So whenever you think the market is frothy and the valuations are attractive, right? You can do a tactical trade, and that's how we are allocating capital. But I don't think if you have a 5 year, 10 year outlook, staying invested into the IT segment per se might not be richly rewarding unless we harness this AI technology brilliantly, become the beneficiary. So today, one of the market worry with IT is the productivity is significantly better, and that's going to impact a lot more IT company showing the revenue growth. And we need to see how our companies can adapt. In the past, we have adapted extremely well, and if you can adapt brilliantly at some point in time, I think the numbers has to prove right. But I think always a trade is possible, right? So we have seen a lot of stocks bounce to 10-20% from the low. And that is what we are trying to capture using a couple of index funds or some sectoral themes. Hope I answered your question, Anand.
So the next question we have from Mr. Panduranga S. He
Yes.
is asking two questions. One, do the mid-cap leaders deserve the high valuation that they're being given now going forward? And the next question is basically India PE multiple versus emerging PE multiple. How will it go forward?
Very good question, sir. I think mid cap doesn't deserve. Is like, see, mid cap is a very narrowed universe, right? Post the SEBI regulation, what has happened? 101 to 250, right? Stocks, which is this 150 has become a mid cap. It's a very short universe. Doesn't have the market bandwidth also. So when the money chases, right? Here is one segment where valuation is going to be generally expensive. If you like to play, you have to play during the bear market. You buy all these assets and then sell it in the big bull market. Otherwise, valuations are very frothy in a good portion of mid cap. So we are not allocating any money to our investors at this point in time. The second question is even more interesting: is India PE multiple vis-a-vis emerging? I think PE multiple is a very good starting point to think about valuations and not a good ending point. And I'll tell you why. If you look at today, you have companies which in within Nifty 50, right? You have companies which have to be valued using price to earning multiple, like auto companies or IT companies, right? Or FMCG. Then you have companies like life insurance, which has to be priced to embedded value. Then you have a bank which is 37%, which has to be valued by price to book. Then you have company which is a loss-making company where we have to value by price to sales. And then you have a cement or infrastructure company where EVB to EBITDA will come into play. I think instead of looking at PE as one ratio, PE gives you a good idea, and PE is going to consistently move higher because if you look at last 5 to 6 company entered into the market, they are very high growth, forward-looking businesses entering. So whenever the index composition changes from a low growth index to a moderate growth or high growth index, the index multiple will expand. So someone were to say our average used to be 20, today 22. I think this 2022 is only Nifty name. The Nifty underlying structure has changed, right? So today we have a lot more high growth company entering into it, which needs higher multiple. I'm not justifying you pay any multiple. Multiple is a function of what constituents in the index. I think today, if you see, large caps are fairly valued, and broad mid cap and small caps are expensive. Very selective pockets of small cap is cheaper. That's how we are positioned. Vis-a-vis emerging market is more of a low ROE, predominantly very cyclical. Komal, can you put your line mute? I think Balaji's voice is. Emerging market ROEs are not very significant like what an Indian ROE is. And emerging market, most few of the markets are very cyclical, both from the business point and the capital flow. I think we have always traded premium to emerging market for the right reason, from the longevity of growth, clarity of growth, and the structure of the market, and very diverse, right? So we have banking, we have FMCG, we have auto, we have IT, we have pharma, then we have infrastructure. So if you look at our index, is far diverse than any emerging market. And I think after the rally in emerging market today, looks like every FI given some stability in India rupee and earnings growth, we might see our market is a little more cheaper to emerging market from a FI point of view. And that is one of our bullish call why we are currently invested into large cap is you be in a place where the next buyer is going to come, and we clearly see the next buyer in the market will be FIs. They have underinvested. Now they want to come. I think with the rupee depreciation, 2026 year could surprise all of us with a good FIF flow, and that can benefit all of us in a very richly rewarded market if you have positioned it well. That is what our endeavor to our investors, and that's what our suggestion to our people.
Yes, so we'll take one last question.
Yeah.
Participants, we request you to email our questions if you have any further questions. So the last question is on overseas funds.
I think I've responded in the previous question on US and China, right? I think we continue to be very tactical in overseas unless somebody is very, very strategic who wants to build it for 5, 10 year period, or maybe an SIP or a very systematic way. You build the exposure in US market by using via some ETFs or some index funds and some selective trade in some other country. But broadly, we see 2025 belong to non-India, right? India become a anti-AI trade, so we have not seen performance. A lot of small cap have fallen. I think 2026, 2027 looks like possibly will be our trade. I think far more exposed to domestic economy can give you a little more better outcome. Obviously, today it doesn't look like because we are yet to see the trade policy happening, the currency stabilizing. So the risk is playing out. When the risk is high, the perception is high in terms of the risk. But I think in next 1 year, our broad view is this will get better. And if your portfolio is well positioned, right, facing India broadly, should actually able to capture the growth and enjoy the fruits of the India's GDP growth. I think with that, I think I'll take the last question where I expect the consumption sector to perform. Consumption sector expected to perform better. I think after COVID, we have seen high inflation in our society that got impacted. That is why subsequently you have seen a GST cut, budget had tax benefits to all of us up to 12 lakhs, right? So I think the government is consistently now taking policy to support the consumption. But at the same time, as an individual, right, we need to be a little more productive, focus on our core job. So one of the primary message which we keep telling to our investor and our well-wisher is focus on your core, earn well, allocate capital, and have reasonable expectation. We strongly see 2026 year should be a better year for all of us, and wish you advance very happy new year to all our listeners. Thank you. I think with that, Komal, we can end this session. Thanks once again.
Thank you all participants for joining us on a lovely Saturday evening. We would like to end the call here, but if you have any further questions, you can reach out to us via mail or WhatsApp us through our contacts. May you have a great day ahead. Thank you, everyone.